inside gaps, meaning prices are gapping from the prior day's close and opening inside gap analysis. In this section, we'll be taking those daily setups that you've learned in TPM1, PVSs, VSSs, climactics, and various guerrilla tactics, and combining them with intraday chart patterns. In other words, we'll use the daily chart pattern for our bias, and then take the intraday chart patterns to guide us for our entry points. Let's begin. Gaps occur in two ways. There are gaps between bars, which creates a void between the two bars, meaning prices are gapping away from the prior bar. And there are inside gaps, meaning prices are gapping from the prior day's close and opening inside that prior bar's range. Now the intraday patterns will appear similar whether they're gaps between bars or inside gaps. The voids are created on the intraday charts, and this is what we'll be looking to trade. Things to consider when trading gap plays. Are the futures or sector the stock is in gapping in the direction of the stock? Meaning, is that stock showing relative strength or relative weakness? Are the futures gapping into a prior area of supply or demand? What effect are the futures going to have on that stock that you're focused on? If the futures are gapping into an area of supply, odds are they're going to retrace back down. If they're gapping down into an area of demand, odds are they're going to rally from that point. Is the tick at an extreme level or near support or resistance? Is the trend at an extreme level, above or below 1 or its 20 MA? Is the gap in or against the direction of the 20 MA on the 5-minute chart? In other words, are you trading against the trend or in the direction of the trend? Is the stock itself gapping into support or resistance? Is the direction of the gap confirmed by the pattern, meaning is it a novice gap or a professional gap? And how did the intraday pattern of supply and demand form on the prior day? This is going to have a large effect on how the stock reacts. Daily patterns can look very similar, but look very different as how they formed intraday. Lastly, if you cannot formulate a strategy, then just stand aside. It's not necessary to place a trade unless everything is in alignment. We'll begin our analysis on the daily time frame. With the buy setups, we'll start with PVSs, climactic buy setups, or potent bullish reversals. These assume a move higher. Should a gap down occur, it should not be more than 50% into the prior day's range. A gap down of greater than 60% may actually suggest shorting, as the buy setup is potentially being negated. The intraday pattern of supply and demand is going to dictate our strategy. Our sell setups will be PSSs, climactic sell setups, or potent bearish reversals, these assuming a move lower. Should a gap up occur, it should not be more than 50% into the prior day's range. A gap up greater than 60% may actually suggest buying, as this could be negating the sell setup. The intraday pattern is going to dictate our strategy. 10-10 bars or 20-20 bars will be the beginnings of those guerrilla type strategies. The prevailing trend will have to be considered, but there's the potential to trade in either direction. And we also look at the intraday pattern of supply and demand within these bars to dictate our strategies. These are our pattern guidelines or setups that we're looking for in alignment with our gap trades. We'll start off with a 2-minute chart. After a gap up, a changing of the guard into the gap fill belongs, meaning price is moving lower into the open gap. As prices are moving down on the 2-minute chart, we have several bars moving down, waiting for a changing of the guard into the gap fill, and then to buy it above the changing of the guard bar's high. For somewhat larger gaps, or for more conservative traders using the 5-minute chart, as it pulls back into the gap fill, and then waiting for a changing of the guard to form there. Now for short setups, we do just the opposite, where prices gap down from a daily bearish pattern where prices rallied into the gap fill and then waiting for a bearish changing of the guard to short it under that bar's low. In example number 1, what this is displaying is on the 2-minute chart, that changing of the guard is happening at the bottom of the transition from that red bar into the green bar. I'm pointing this out so that you realize that we're really looking to ignore the 5-minute chart if we're using the 2-minute chart. ignoring it from the point of view of we're not going to avoid a trade because the 5-minute first bar is red. What we're looking for is for the red bar to be ignored because of the daily chart pattern. With the 5-minute, it's the same. So as prices are moving down on the 5-minute into the gap fill and getting a bullish change with the guard, the first 30-minute bar will be red. And we don't avoid taking the trade because the higher time frame is a red bar. Because the daily time frame is bullish, we're into an area of support, and we're looking for prices to move up after we've gotten the signal of a bullish change at the guard after multiple bars moving down into an area of support. Now at bullish patterns, if they gap up and the first 5-minute bar closes bullishly up near the high, we can then buy that above that bar's high. Now, we don't want the gaps to be excessive, which is then would create a price void underneath. We want moderate gaps. And as we get in further into this chapter, you'll see the specific patterns that we're looking for intraday. And so for shorts, a gap down, where the first 5-minute bar closes near its low, we'll short that under that first 5-minute bar's low. Now with 30-minute highs and 30-minute low plays, what we want to see is a consolidation prior to the break to a 30-minute low or prior to the breakout above a 30-minute high. What we don't want to see is a greater than 100% retracement, meaning prices had moved up initially, formed a V-top, and then continued to move down, breaking to a new low on the day. That type of 30-minute low is much higher risk. What we're looking for is several bar consolidation and then a break to a new low, or for longs, a several bar consolidation and then a breakout to a new high. And as always, with our gap plays, the intraday structure of supply and demand and bar by bar analysis will be used for the timing of the trade. Here are alternate setups. It says at times the market may not present a clear signal to you for the earlier entry, or you just may not be comfortable entering with that earlier entry. So additional time can offer you more information for making a better decision. So again, starting with the daily setup, a PBS or a climactic CBS, a 5-minute pullback forming a pristine buy setup would provide us an entry. With the daily sell setups, PSS or climactic sell setup, waiting for a 5-minute PSS would give us an entry. Now, these can form after a greater than 100% retracement, meaning the 5-minute may take out the low of the day and then form that bullish change for the guard, or the 5-minute PSS may take out the high of the day and then form a bearish change for the guard. The fact that they've taken out either the low of the day or the high of the day with the sell setup is okay. Remember, the daily time frame is on our side here, the trend and the direction of prices from the longer time frame. With a daily sell setup, PSS or climactic sell setup, we'd look for a failed pristine buy setup. Buy setups should fail when the longer time frame is saying that prices should go higher. We don't want to take the PDS because the daily time frame is saying that prices should go higher, so we're anticipating that the buy setup will fail and prices will move lower to the downside. With a daily buy setup, PBS or climactic buy setup, we'd look for a failed PSS. Now if you go back to the trend section as we talked about it, these would actually be level 1 pivot sells or level 2, I should say level 1 pivot buys. And what we're looking for here is a correction bar, if you will. We're looking for a bar that would take out the prior bar's high with the failed PBS and then close weak, subsequently resulting in 2 bars moving to the downside with lower highs and lower lows. Remember, a level 1 pivot doesn't become a level 1 pivot until you've had 2 more bars moving to the downside here with the failed PBS, or 2 more bars moving to the upside here with the failed PSS. This is no different than buying a pristine buy setup, which later on, if it was to work out, would result in a level 4 pivot type of action. Here you have a selection of intraday bullish patterns. This is a good slide to print out and keep next to your trading desk. and keep an eye on for these patterns here. Changing of the guards into the gap fills, retest patterns, new high bars, taking out the first 5-minute bars high, PBSs following an initial move up, the failed sell setup, 30-minute highs after consolidations, a 1-2-3 continuation pattern, or other bullish. Realize that patterns are going to form in different ways on different days, but this slide gives you an excellent start for what to look for. And most likely, one of these would set up on any day that you'd have a bullish daily setup, gapping up the next day, and looking for these type of setups would give you excellent entry points in alignment with that daily setup. With our bearish bars, as we look inside these bars, we want to focus on whether prices were declining at the end of the day or whether they were basing at the end of the day. Daily bars will look very similar, but looking inside of them or taking that x-ray inside those bars can reveal a very different pattern. So with the bearish bars that are falling at the end of the day, these will provide better gap and snap type patterns. As prices were falling, there's little to no overhead resistance. So if prices were to gap down and then come back into a pattern like this, odds are much higher that prices can rally from there and continue to move up. Whereas with the example on the right, the end of day base, if prices were to gap down from this pattern and rally into it, this would set up a better PSS type of a pattern with the overhead congestion directly above. On the other hand, if prices were to gap up from a pattern like this above the area of congestion, this would then provide support on a pullback, and with a significant gap up and a pullback into that support, we could actually consider buying a PBS on the intraday time frame. So all of our bearish bars, we're going to take note of whether the prices were declining at the end of the day or whether they were basing at the end of the day. Again, a gap down from an end of day base is going to provide a significant area of overhead resistance, whereas a gap down from an end of day decline will provide little to no overhead resistance. With bullish bars, we'll be looking for whether they formed end of day uptrends at the end of the day or end of day bases. The end of day uptrends will provide little to no support if prices were to start to move back inside of that bar's range after a gap up. So these are better gap and crap type patterns. Whereas the end of day base, if prices were to gap up and pull back into that unfilled gap area and that base, this will provide better PBS type of setups. Additionally, if prices were to gap up from an end of day base with this bullish daily pattern, this would be better to buy above the first 5-minute bar's high if it wasn't a significant gap. Whereas buying above the first 5-minute bar's high with the end of day uptrend would likely result in prices moving against you relatively soon. So with bullish bars, we're looking for either end of day uptrends or end of day bases. And with the end of day base, if prices were to gap down under that consolidation, this would provide a better setup for a PSS as prices moved up into that unfilled gap and that congestion. Again, that would assume a bullish 5-minute bar, which would suggest prices would move higher. If prices were to gap down and you've got a red bar closing near its low, then we can consider a short setup for a pattern like that, since it's gapping under a consolidation and there's a void below. We do the same with bottoming tail bars. So a bottoming tail bar tells us that prices were lower and then rallied from some point. So were they rallying at the end of the day, or did they decline in the morning and rally in the morning or in the middle of the day and then consolidate in the afternoon? And a move up from an end of day base, bottoming tail type of a pattern, is going to provide a better setup, or a 5-minute bar closing near its high and above its open, taking that above the high, versus an end of day uptrend which is already moving up multiple bars in a row. The topping tails will do the same analysis. Was there a decline at the end of the day, or did it decline earlier in the day and consolidate in the afternoon? With the end of day decline, this type of setup, if it gaps down from this, would probably be better waiting for a 30-minute low to break, consolidation prior to the break, and then a breakdown. Whereas with the end of day base, we'd be more comfortable shorting under a first 5-minute bar's low if it closed below its opening price, or if it had gapped down and then rallied from the gap down and rallied into the gap fill and the consolidation and shorting a PSS. On the other hand, if it gapped up from the end of day base, this would then provide support, and we would have to wait for prices to decline under that consolidation if we were going to short it. Okay? If it was a significant gap up and prices declined into the unfilled gap and that area of support, we would also look for a PBS type of setup for a scalp and a reversal back to the upside. In the next slides, we'll be looking at examples of gaps from daily charts. Inside the blue box displays the two daily bars that formed. The bottoming tail bar, or the first bar inside the box here, we do not see any of the intraday data. Inside the second bar, and in this case the green bullish 10-10 bar, we have an end of day base. So what you're looking at here is what occurred at the end of the day inside the second bar. And this is what we'll be looking at in all of the examples. The gap up of where it says open will start the new data that had formed. So with the red slash mark that says open is where the opening prices are inside of the red square in this example. And this is what we'll be looking at in all the next slides that are coming up. So in this example, we have a bottoming tail bar. Remember, this was a bearish bar that was at its low and then rallied back up toward the high. On the next day, prices had gapped down near the low of that bottoming tail bar and then must have rallied in the morning. We know it must have rallied in the morning because we have an end of day base and we have a bullish 10-10 bar. So the end of day base now provides an area of support. Well, prices had gapped up the next morning from the bullish pattern. Now, we're not looking to fade this or short a gap up. While it did decline from there, what we're looking for is prices to decline into that area of support and then look for a turnaround bar or a changing of the guard. What we see happens is prices came down into the area of support. Notice the narrow body bar tells us that momentum was slowing. This was followed by a bullish wide range bar. Now the bullish wide range bar, we know, forms a void inside of it. So a consolidation at the top of a bullish wide range bar is a positive pattern. Notice how the small candle bodies are all on the top of the bullish wide range bar. Lastly, look at the bottoming tail bar just prior to prices moving to the upside. It took out the low of the prior bar. This is a form of a correction in of itself, a bar taking out a prior bar's low and then rallying up to the top of the bar. Right? Our first reference point of support is the prior bar's low. So taking out that low tells us that selling came into the stock at that time. That'll help remove supply. Those that are looking for it to move higher, in other words, to sell into that move, that correction bar gives us a signal that if prices take out the high of that correction bar, prices should start to move higher. Once they do, we begin trailing prior bar's lows. Now as prices come up into the high of the day, in that red square, we really have no idea whether prices will stall there and begin to move down. But what we do have as part of our method is to trail prior bar's lows. That's our first reference point of support. So as long as prices are moving up and do not take out a prior bar's low, our assumption is that that area of resistance should be overcome because of the pattern on the daily time frame as well as the intraday time frame, the end of day base, the pullback into that congestion, the bullish wide range bar up, the correction bar, which is the bottoming tail bar, and then taking out that bar's high. Here we have a daily pattern that did suggest that prices were going to move up. And the topping tail bar is a narrow body bar. And the next bar that day opened in the area the prior bars closed, and then rallied up toward the high of the day or formed a 10-10 type of bar. On the next day, the gap down was significant, gapping down more than 60% into that bar. Now when we look inside of the bar, what we see is that there's an end-of-day base. And a gap down under an end-of-day base is going to create an area of overhead supply. Also notice the pattern. Prices rallied right up into the close to a new high. So this tells us that overnight holders were thinking that prices were going to go higher, and now they're all holding losses. You can see why that whole consolidation now becomes a reference point of supply. But the first bar became a topping tail bar. So when it gapped down, it attempted to rally from there. It moved into that area of supply and then dropped again, back down to the lows. So shorting it under that first 5-minute bar's low is an excellent setup. Why? Because there's an area of overhead supply. Right? Those traders are holding losses. They're going to want to exit those positions. And the fact that it rallied in the morning tells us that there's a void underneath. So there's little to no support, and prices should drop once it takes out that bar's low. Here we have two bars telling us that prices should move higher. Right? A narrow bodied bar and a bottoming tail bar. And these bars are making higher highs and higher lows. Now the gap up the next day creates a price void. That's what gaps do by definition. Now, bullish bars may not necessarily come down and fill the gap if there's strong demand. And the ones that have the highest probability of not filling the gap are the ones that gap up from an end-of-day base. The stock was resting into the end of the day, right? So there are a few that really want to take profits at that point. So when it gaps up in the morning, the first bar is a red bar. This produces thoughts based on our analysis that we might get a PDS into the gap fill. But prices on the next bar resulted in a green bar. While it has a small tail on the top and a small tail on the bottom, showing some indecision, but there was no follow-through to the red bar. Now on the third bar, there's a slight gap up, and it closes below its opening price, which suggests that maybe it will pull back from there. And this is how we do our bar-by-bar analysis. It keeps us in the moment of what's happening. On the following bar, we get a green bar that engulfs the prior red bar. There's no follow-through to the red bars. This tells us that there's strong demand. That last green bar took out the high of the preceding 3 bars. This tells us it's time to get on board. When you buy above that bar's high, put a stop below the low of the day, and then start trailing prior bar's lows and see how far it'll go. Here's an example of a 30-minute high breakout, an ideal 30-minute high breakout. We have a daily pattern where prices were moving up, higher high and higher low between the bars. We have a 20-20 bar, a bullish bar suggesting prices will move higher. Now, this type of a bar where the range is wider, we look inside of it, we see that it was an end-of-day base. This tells us that the odds are prices can move higher. This stock was resting into the close and throughout the afternoon. So while this might not be an attractive setup based on the daily for those of you that are swing trading, those of you that are looking to play a gap strategy, this is an excellent setup. A bar that produces this kind of a pattern, a big up bar, right, can be up the same way the next day. You can have 2, 3, 4, 5 big up bars. Right? And what we're looking for intraday is their support. And in this case, there was. Now, as prices gapped up and then pulled back, we see that there's a large red bar or bearish wide range bar coming right into the gap fill. So at that point, we see that there was strong downside momentum. But prices stalled. Note the doji bar right on top of the prior consolidation. From there, prices rallied straight up, and we get a bullish bar right up again. Now, prices moving straight back up into that overhead congestion, right, could lead to a 30-minute type of breakout or a new high breakout at that time, but we don't want to enter after a greater than 100% retracement. What makes this ideal is that when it came up to the top of the consolidation, it based for 3 bars prior to breaking out. So the high of the day there, which was providing a reference point of resistance, that resistance was absorbed by buyers at that point, and prices would not decline. Then as they broke out to a new high in the day, we're buying a breakout after a resting period, which has much higher odds of following through and not coming back down into the base, since the prices have already consolidated and absorbed potential sellers near the high of the day. Here we have a significant gap down from a bullish pattern. Now in this case we had an end of day rally, so there's little resistance overhead here. This is why we're using the alternate setup in this case. While you could have shorted it under the first 5-minute bar's low, that's going to be a more aggressive entry. The alternate setup creates a new area of resistance, so shorting a PSS from there offers us a lower risk or more conservative entry for prices, looking for prices to drop. But we want to look at market internals here, and alternate setups are going to be the key to higher probability setups. These two bullish 10-10 bars, followed by a gap opening from an end-of-day rally, really sets up a high probability gap and crap type of a pattern. Now what we see happened intraday here was prices gapped up and then started to move up. Notice the slowing momentum, the small candle bodies, and then just prior to the new high, you get a small candle that closes right on its high, followed by a breakout failure. This is a high probability pattern to short with a pattern like this with an end of day rally after two 10-10 bars like this. It strongly suggests that prices will move back down again. Now as prices come down into an unfilled gap, it is a reference point of support. And this pattern, most of the time, would have resulted in a continuation move to the downside. Rather, this one began to stall and move sideways throughout the morning, right? And actually attempted to move higher. If you look at the pattern, it actually sets up a W type of a bottom here. Right? You had a bullish changing of the guard, and as prices moved up and then was retested by that red bar in that area, it was followed by a bottoming tail bar, and then prices moved up from there. But that pattern failed, telling us that there was a large amount of overhead supply and the likelihood that prices would go lower. Right? That was a potent bearish changing of the guard, and there was a void below. This suggests that prices should continue to break down from there. As prices came down into that cluster of opens and closes, that was the first reference point of support to the left. Momentum did stall there, and then subsequently went lower from there. This daily pattern shows us that momentum was slowing. Notice the narrow body. Prices had gapped up from there. Now as we look at what happened intraday, there was an end of day decline, and there's an area of overhead loose supply. We define loose supply as pivot highs and lows. Loose supply is going to offer a smaller area or a lesser area of resistance to the left versus a tight area of supply, which is defined by overlapping candle bodies. As prices gapped up from that end of day decline, that first 5-minute bar closed right at its high, this giving us a signal to buy above that bar's high, looking for prices to move higher. And as prices came up into that area of supply, odds are the momentum is going to stall. So as prices broke below a prior bar's low, that would be your signal to exit at least part of the position. The fact that prices went sideways in this area of loose supply, as well as the 200-period moving average, tells us that demand was very strong for this stock. The fact that it did not go down at that area of resistance, rather moving sideways and then higher again, told us that demand was strong. Now what you're doing is you want to read what's happening when prices reach a reference point of overhead resistance. When it will not decline, rather going sideways, is a strong signal that prices are likely to continue to go higher. The next step in the process is to look at where they're likely to go higher to. What's the next reference point of overhead resistance? That'll be the likely stopping point. Here's a minor gap down from a daily PDS. We had a bullish reversal here and a small gap down. Now the first 5-minute arc does close at its high, but it's questionable as an entry since the gap fill is directly overhead, and we know that traders are focused on that as a reference point to sell into. As it came up into that, and it began to absorb supply, and then a reversal occurred and prices pulled back. Now, as they pulled back toward the low of the day, which you'll notice was right at the 10 o'clock reversal period, the momentum immediately stalled, forming a PBS. And so as it took out the high of that narrow range bar and the bearish red bar, that was your entry point. Those of you that want to wait for the changing of the guard, that did occur on this day. Sometimes the changing of the guard will not form, or when it does form, it'll be a much larger bar, I should say. It has to form on the reversal. When this formed, if you're waiting for the changing of the guard, your entry would have been above that bullish changing of the guard, and then again you go into trail stop mode under a prior bar's low. Once prices began to move, we know that there are going to be sellers at the high of the day. That's just how the market operates. But we have our reference point of support, a prior bar's low. And in this case, prices continued to move up even after the momentum stalled. Notice the larger green bar, the smaller topping tail, and then the slowing momentum, that little doji bar. Prices never broke underneath that bar's low. It tells us that there was strong demand. Prices continued to move higher. We focused on end-of-day declines or advances or end-of-day bases. The patterns can form many ways intraday. But as those patterns form intraday, how they end at the end of the day typically follow through the next day. What we see happened on this particular slide was there was a retest of a bullish changing of the guard, and then another bullish changing of the guard at the end of the day. This suggesting that prices could move higher. Now when they gapped up the next day, they gapped above that area of what would have been overhead resistance. Now as prices pulled back from that pattern, and take note of the bottoming tail bar just prior to prices taking off. It took out the low of the preceding 3 bars. And this is what we would refer to as a correction type of a bar. And then prices rallied back up toward the high. And I want to reinforce the fact that this was a bearish red bar prior to completing itself as a bottoming tail bar. So this provided an entry above the high of the bottoming tail bar, or for those of you that want to be more conservative and wait for the bullish changing of the guard bar, you can enter above that bar. But your entry is above the high of the bottoming tail bar. That was prices had pulled back. You've got the correction bar, and then it takes out that bar's high. And so as prices begin to advance from there, again you go into trail stop mode for initial exit under a prior bar's low. Keep gap trading in perspective. It's a short-term event. 15 to 30 minutes from your trade of entry point is the norm. The longest you'll go is probably an hour with a gap trade. After that period of time, the market should have either moved in the direction of the trade, stopped you out, or given you the additional information needed to make a decision. Use bar-by-bar analysis, market internals, and the analysis at the end of your day, supply and demand, and the time frame being traded. This will direct you. Remember, what appears to be the probabilities from a daily chart perspective is not always the case. Daily bars can look exactly the same, or very close to the same as one another, but how they formed intraday is how you'll have to make your trading decisions.